mean, it's clear that Europe is probably in the most difficult position if you look at most of the developed economies because of the very high dependence on exports, of the very high dependence on Russian energy. And so for Europe, given the fact also that they are in a situation in which societies are very fragmented, in which social obligations cost a lot of money, with relatively limited further budgets, it will be probably most challenging for Europe to master that crisis.
You're good at risk. AXA has a risk radar. Which countries in Europe are you most concerned about?
I'm concerned about Germany. I'm concerned about France. I'm concerned about Italy. I'm concerned about Spain.
We're talking all the main ones then that we're concerned about.
Yes. The smaller ones have found a way to adapt themselves and to be much more nimble. But those very large ones have to deal with everything I said earlier. The question around how do they sort out the energy autonomy? How do they make sure that they can really keep the social glue together, knowing that the means of fiscal policy are very limited? And how do they make sure that they get back to growth?
Let me ask you about interest rates then. We had a long conversation for many years on CNBC talking about whether central banks were out of ammunition when it came to stimulating economies. Now as we talk about central banks wanting to tackle soaring inflation, I wonder whether it's the flip side of that story where we've got an ECB that may not have as much mileage to tighten rates as it thinks it does. I mean, the ECB was very clear yesterday, Christine Lagarde in a post signalling very explicitly that rates are going up in July, possibly then September, and there was a pathway after that as well. But there's a big distinction between the United States and Europe. So what do you think the pathway is to tighten? How much room does the ECB really have?
I think we have to very much differentiate the US from Europe because we're in a very different situation. In Europe, inflation is not at the level that we find in the US, and certainly, as we said earlier, the danger of a recession in Europe is much higher. So my scenario is that yes, we will see some rate hikes in the short term, but and you saw it the other day with the Bank of England, a rate hike was announced, and at the same time a recession was announced. So my view is that probably interest rates will go to 1 to 2% in the longer term and will probably stabilize there with a more difficult economic climate coming.
Can I ask you about the social aspect when it comes to your business? I mean, there's been a ton of targeting around climate change, a lot of action that's taken place there. It jumped out to me during earnings season through the lens of Target when it was reporting saying, look, we've got higher costs. We don't think it's right now to pass it on to customers, even if it hits our profit margins and bottom line. If I take a look at your industry, we've seen premiums, we've seen margins all expanding. Every reason to reprice risk has effectively been passed on to the customer. Is it time for you to step back and say, look, there's a social good here. We need to accept shrinking profit margins and take on some of the higher inflationary pressures?
Look, I mean, we're a business that is in the middle of society, and so what we need to do is insure everybody. And in our system, if out of 10 people, 1 is sick, the other 9 are helping, which means that can only work if the financial balance in that system is kept. And therefore, when the price of risk goes up, we obviously need, for the benefit of the whole society, need to increase prices, that the model still works. We will certainly enter in a time now where it will become more difficult because certainly the end consumers are feeling price increases from everywhere. So it will become more challenging now. Yeah?